Today on KYC, we have a bank which has an ROA of 1.8%, but is available at 0.8 times price to book. That's why it's interesting, and that's why we've taken up Tamilnad Mercantile Bank. The stock was up yesterday on the back of numbers, and this is why it's a proposition which we are considering on KYC today. Is this really a proposition that you want to take a bite of? And that's what we'll try to get perspective on. Growth concerns, well, this is where there's been a bit of a challenge, at least over the last few years. Should we continue to be worried is really the question, and we'll quiz management on this, and try and get perspective. And last off is with regard to the general downside risks that banks have. One is with regard to margins. Second is therefore where to expect ROA to come from. If the current ROA is 1.8%, if that ROA were to fall, will it dramatically change things with regard to the bank? And asset quality? How comfortable is the bank with regard to that? So we'll speak about all of that and try and get perspective. But let's first take a look at what the bank has in terms of the past history, as well as what it does in terms of its lending. And I'm going to start off with a little bit of background with regard to the bank. It was founded as Nadar Bank in 1921, opened to the public on November 11th, 1921, renamed Tamilnad Mercantile Bank on 27 November 1962. It had 4 branches in 1947 in Tamil Nadu, became an early adopter of technology in 1984, introducing ATMs in 2003. It operates 578 branches currently across India, and has a branch and has an ATM network of around 1157 ATMs. It also has 358 cash recycling machines. So that's just some perspective on the size and the type of bank that we're looking at. In terms of loan portfolio, it's into retail, agri, MSME, and a lot of this is actually corporate. And this is all INR crore. That's how it stacks up. In terms of the size of the book, not too large. It's just about 45,000 crore in terms of book size, around 6,000 crore in terms of market capitalization. So that's broadly how this one stacks up. Let's look at, and let's break this up into percentages if we can. Retail is around 21%, agri is around 42%, MSME is around 31%, and 7% is others, which is largely the corporate book. So retail, agri, MSME, largely focused. 93% of the book is concentrated on retail, agri, and MSME. Let's try and break the NPAs up as well on each of those. Look at the NPA ratios in terms of asset quality on each of those. MSME is 1.54, but really others is where the pain has been, and that's just 7 to 8% of the book now. What are they going to do with the corporate book is the other piece I would want to know when we speak with management, and we'll quiz them on that count as well. But let's look at the metrics that we'll look for, and we'll speak with Mr. Sally S. Nair, who's the MD and the CEO since August of 2024. He's taken charge of Tamilnad Mercantile Bank. A few changes as well he's made with regard to processes on the lending side of things and strategy as well, and we'll quiz him with regard to all of that. Let's quickly look at the metrics that we'll be tracking today on Tamilnad Mercantile. We look at income statement, balance sheet. We look at operational metrics, asset quality, return ratios, shareholding, street cred, and valuations. We'll try and break Tamilnad Mercantile on each of these metrics. Let's start off with the income statement. And mind you, it's a small bank in relative terms, and therefore in terms of size, given that it's small, you would expect that it grows at a faster clip. So let's look at the income statement, see whether they've been doing that. They've been growing net interest income at just about 8% 3-year CAGR, so not impressive. 5% on operating profit, and around 13% on profit after tax. The 13% on PAT doesn't look as bad, but compared to the single-digit growth in net interest income, that's a lot of that profit after tax is also coming from the lower provisions number, the provisions number has gone down from around 700 crore in FY22 to just 171 crore in FY25. So it's the lowering of credit costs which has led to that profitability spike. But when you're looking at the overall growth numbers, if you can pull those numbers back up, it's just about single digit with regard to top line, which is net interest income. And that is not very, very, lucrative from a growth perspective, given that the size of the bank is extremely small. So an 8% growth, 3-year CAGR, well, doesn't look impressive at all. We've given this a thumbs down, therefore. Let's look at the balance sheet, though. And in terms of balance sheet metrics, we've seen gross advances go up by around 10% on a year-on-year basis. Deposits is up 6% and CASA is up just about 1% or so. So that's how it stacks up. Again, from a balance sheet growth perspective, not looking extremely lucrative. You want better growth from a bank of this size. We'll quiz them on a couple of these factors. Largely, what we are seeing, therefore, is slow growth with regard to how this bank is playing out. That's where the worry or the concern is. Let's look at key ratios, though. Let's look at yield on loans. We've seen a bit of an inch up versus FY23 in FY25. So we've seen some of those metrics get a little better. Cost of deposits also we've seen an inch up and expected, right? We've seen the repo rate go up all the way to FY25. Now we've started to see a taper. So we'll start to see some of those metrics play out as well. Net interest margins, we've seen a taper down, understandable again. Cost to income ratio is actually between the 42 to 45% mark. So largely in line. When I'm judging Tamilnad on the basis of margins as well, it's not a very bad margin number. You've got peers which are doing 3.5%, something like a DCB bank is doing maybe 3.7%, a City Union Bank as well, and then you have certain peers which are doing higher margin. So I wouldn't be too concerned with that margin number of Tamilnad. I'd call that a thumbs up for sure. But essentially, it's the ROA number which governs all of these metrics, and it all comes together with that ROA. And look at the ROA, it's been fairly steady in that sense. You look at the ROA for FY23, it's at 1.97%, FY24 is at 1.84%, and FY25 is at 1.88%. So fairly steady ROA. Even within FY25, the last 3 quarters, you can see on your screen, 1.94, 1.89, 1.88. So fairly steady with regard to where the ROA metric is. So clearly a thumbs up with regard to the ratios that it's clocking, both in terms of margins as well as ROA. But what I want to see is growth along with this ROA. If that were to get balanced, things would change quite dramatically with regard to this bank. Let's look at asset quality, because that's the other metric that one would want to look for. One is the operational side of things, one is the asset quality side of things. And you're seeing a steady performance in terms of GNPAs, at least over the last 3 years. Even net NPA ratios fairly steady over the last 3 years. So both of those metrics doing well. We'll give this one a thumbs up as well. Let's look at return ratios now, because when you're looking at a bank, your return ratios of course matter. So from 15% in FY22 and FY23, return ratios have fallen to around 12.5% in FY24 and FY25. I would believe that some part of that would be because there is no growth coming through. If growth were to kick through, you could likely see return on capital also improve substantially with regard to where this bank is. So something to look out for is that growth number for sure. But nonetheless, we'll give this a neutral, given the fact that you're still clocking an early teen kind of return ratio, nearly an early teen. And if growth were to come back, you could see an uptick in terms of return on capital, so which is clearly going to be a positive if it were to play out. Now let's look at shareholding pattern. Now generally in banks, you might have a promoter or two holding maybe 15% or maybe 20%, 25%, depending on how the RBI has enabled that ownership. Or you may have a large set of institutions holding small chunks of the bank. In this, it's neither. There's a public holding which which is large, around 94%. Outside of that, its FIs, DIs dominated. And therefore, we'll give this a thumbs down because there could be some bit of drag with regard to where the shareholding is. No large ownership owned by any one set of individuals or parties, and therefore something to look out for. Let's look at street cred now. It's a recently listed bank. It's listed at around 525 rupees. That was the IPO price. Thereafter, currently, the stock price is at 450. So not looking too good from a shareholder return perspective from an IPO standpoint. Even now, you've got really muted returns coming through last 3 months, 6 months, etc. But nonetheless, we've not seen this get beaten down in a significant fashion over the last 6 months. Mind you, small and mid caps have really faced pressure, but the stock is up 8% in the last 6 months. So it's a fairly balanced setup in that sense. You're not seeing too many large downsides to this where the stock price performance is concerned, while we're not even seeing very large upsides. So we'll give this a neutral for now, while IPO holders will still be holding the stock, and therefore you might believe that you've not got any returns whatsoever, but also you've not seen too many downsides to what you've seen, and therefore we'll give this a neutral, at least with regard to street cred. Now to the most interesting part with regard to valuations. Let's quickly look at that. And why is it interesting? Because let's first look at the journey of the book value per share. As you can see, from 321, it's gone to 374, which is roughly a 54 rupee EPS. From there, it's gone to 437. From there, it's gone to 500. Now it's sitting at 569, right? That's how the EPS journey has been for Tamilnad Mercantile Bank and how the book value journey has been. The current market price of this stock is 450 rupees. So it's trading at 0.78 times price to book trailing 12 months. What we've done is we've assumed that the same EPS will continue for next year as well, FY26. Mind you, there's no analyst coverage here, so we've had to rely on some bit of judgment and some bit of what management has said over the last few quarters as well. And of course, we'll get management commentary coming through to you as well. So a couple of those factors is what we've built into our assumptions. Let's assume the FY26 EPS to be at rupees 75 and no growth in EPS between FY25 and FY26. In that case, your FY26, which is your 1 year forward price to book, is 0.7 times. That's super cheap for a bank with an NPA ratio, if we can pull those ratios up with regard to NPAs and asset quality. If you look at the NPA ratios, they've been fairly controlled. Your gross NPA has been below 1.5% for the last 3 financial years. Your net NPA has been below 0.9% for the last 3 financial years. So for that kind of a setup to be valued at 0.7 times 1 year forward, it looks slightly anomalistic, and therefore we're going to give this a thumbs up because valuations definitely supporting the kind of play that's happening with regard to this bank. You may want to have a look at that as well. But you know what we're going to do? We're going to understand this better. But before that, let's quickly look at our KYC ratings and we'll break it all up. We had a thumbs down with regard to the income statement. Why? No growth. Balance sheet as well, very, very slow growth. Remember, it was just 9.5% 3-year CAGR on the loans and advances that this bank has. The operating metrics were quite positive. 4% plus on margins. Asset quality as well was holding up fairly well, at least over the last 3 years. So we'll give it a +1 or rather a thumbs up with regard to both of those metrics. Return ratios, we'll give it a neutral because from 15% they've come down to 12.5%. Can inch up if growth were to come back. We'll also give a thumbs down to shareholding because largely held by public shareholding. Street cred, we're going to give this a neutral, and valuations, we've given it a thumbs up as well, and we've explained that metric and our assumptions within that valuation metric. And we've given this a 4.5 on 8, Tamilnad Mercantile Bank. But can some of those metrics change? Can there be a positive bias? And what could the downside risks be? Let's try and understand that a little bit better. We have Sally S. Nair, who's the MD and CEO at Tamilnad Mercantile Bank, joining us. You know, Mr. Nair, I'm going to start off with the key concern for me at least. The last 3 years, advances and deposit growth, CAGR, is just about single digit. Can that change? Can that improve? And what's the likelihood of that?
Yeah, thank you. It's indeed a pleasure to talk to you today. Yes, Tamil Nadu Mercantile Bank's growth has been muted both on the deposit side and the advances side in the last few years. But I think that's a trend that we are trying to arrest. A lot of initiatives have been taken. And if you look at the results of FY25, which I'm sure we will talk in a little more detail, it sort of reflects the kind of initiative that we have taken. On the deposits front, we have doubled what we had in previous year. On the advances front, we've almost doubled, right? If I look at the numbers, in FY24, the growth in deposits was 3.66%. And in the current year, the year under scrutiny, FY25, it is 8.43, more than doubled. And the advances from 6.35% the previous year to 11%. So we are not still there, but we are almost getting ourselves aligned to the market. And the initiatives that we have taken, like I said, is going to bear fruit. It will take, I think, another couple of quarters for it to bear fruit. We have taken a number of initiatives to sort of kickstart the growth, to move the needle up, to generate the kind of profits that we are looking for, that we are entitled to. I think it will take a couple of more quarters. But you notice the numbers that we have delivered in FY25 itself is beginning to be aligned to the market. And I expect in FY25, FY26 going forward, it would be fully aligned with the market, perhaps even a tad better than the market. That's my reading of the return from the initiative that we are taking.
Got it. So where will the growth number lie in FY26 therefore?
See, FY26, as I see it, is going to be a year of a bit of a disruption for us, because the number of initiatives that we have taken is resetting the bank into a growth trajectory. You know, change is never easy. But despite that, I expect the growth in the current year to be somewhere in the 13 to 14% range.
Okay. And where will the growth come from? Where would the loan mix be at? How would there be any major shifts to that?
If you notice the FY25 numbers, I think our RAM, the retail, agri, and the MSME sector is at 93%. You know, I don't know if you go back in history of the bank, we did have a sizable corporate book where we took a serious hit. And thereafter, we changed course and we have been looking at the RAM portfolio. And that's where consciously we have been growing. And that's reflecting in the numbers. In fact, in FY24, we were at 91%. We have moved up to 93% on the RAM. So total portfolio, the RAM share is now 93%. So that shows the kind of focus that we have. It's not that we will not be getting into the corporate sector back, but that will be in a very, very limited way. After, like I said, the initiatives that we have put in place, the risks, the appraisal system, the risk management practices that we are putting in place, after it takes root, we will maybe look at a corporate book in a limited way. But at the moment, the focus would continue on the retail, agri, and the MSME sector. The retail would be a focus, and the MSME would be the other focus. To just mention that we have just started a credit management center. We are sort of centralizing the credit delivery and the credit appraisal systems in the bank. And I think the focus there is going to be the retail and MSME in a large way, and agri in a limited way. Yeah, that will continue to be our focus.
Point taken. Your yields, sir, haven't gone up substantially. When I'm looking at it, FY22 versus FY25, not seeing that very sharp movement that we've seen versus how the repo has gone up, and now of course we are starting to come back down. So where should we expect that yield number to be at, and just explain this phenomena to us?
The yield, if you look at the yield, I think the yield has slightly moderated in FY25, and yield on the advances, and perhaps the cost of deposits may not have moderated to that extent. So one of the reasons why we see a bit of a moderation happening on the net interest margin. Like I said, the kind of portfolio that the TMP was managing earlier, slight ticket size was a challenge. We were on the lower side of it. We are trying to ramp up the ticket size on the MSME particularly. But when you look at the ticket size, moving up the ticket size, and when we are looking at sort of improving the quality of the portfolio per se, and if you look at the GNPA numbers, if you look at the overall stress numbers, you will realize very clearly that we have delivered some of the best numbers in the market. So when we start, ramping up the quality of the portfolio and aligning the prices to the market, we anticipate a bit of an yield sacrifice there, and we are fully prepared for it. And I think, having said that, in FY26, we would still be defending a 3.80 kind of net interest margin. I find the yield on the advances going down marginally, and despite the rate cut, the deposit yield may not move down to that extent. I'm looking at a deposit cost of deposits in the 5.9 to 6% range in the current in FY26, not significantly going down. We'll see how the rate cuts take take shape. But we will certainly see that the NIM in the 3.8 to 3.90 range is sort of defended for us.
What gives you that confidence, sir? Because you will see a downtick with regard to your yields, and you won't see a downtick with regard to cost of deposits. So what's giving you that confidence?
One, of course, is the CASA that I just mentioned about, the initiative that we have put in place, and the kind of strategies that we have sort of initiated in the month of April itself for the year. We are looking at a CASA growth in percentage terms at least 1.5 times of our the term deposit growth. I think that's the kind of call that we have given to our ground force, that to ramp up the CASA, and of course the ground force is also being put in place to support that. So that should help us in moderating, in sort of ramping up the low-cost funds, and giving us some kind of a leeway to keep it at 5.9. I'm also mindful that the industry, industry itself is having a bit of a challenge in getting the deposit. So 5.9, I think, is something that we were hoping and to sort of steer the bank towards in terms of cost of deposits. But when on the other side, yes, I think there will be a bit of a moderation on the MSME, particularly as we ramp up the portfolio. But we also have a significant jewel loan now. 40% of our asset side continues to be jewel loan. Jewel loan will also continue to grow in tandem with what we are expecting in the MSME and the retail side. There we expect some kind of a I don't think yields there are going to go down as the others we expect. So overall, I think on the other side, on the deposit side, with sort of the CASA supporting us, and the other on the asset side with the jewel loan portfolio somewhat insulating us from rate movements, I think we can get to a 3.8%, 3.8 to 3.9% kind of NIM. And that's our expectation for the current year.
Okay, and on the ROA number, and I'll break this up into two. One is FY26, and then in FY27. So FY26, what should the expectation be like? And thereafter in FY27, as you mentioned that there'll be a bit of a kicker thereafter, what should the ROA expectation be?
ROA is at 1.88. I think fairly good. I'm sure you'll acknowledge that it is good. See, there's this, like I said, significant amount of initiatives have been taken, and part of that is on the IT side. IT is something that we see a significant ramp of capex happening. Like I mentioned earlier, we are putting in the LOS, LMS. We are completely revamping the internet banking, and a whole host of IT initiatives have been taken to modernize the bank. So that is one aspect that is going to take a bit of cannibalize the profit a bit. The other aspect that we are also looking at is how do we reorient our branches towards strengthening the liability franchise. So a bit of an investment is going to happen on the branches side also. We are looking at something like 50 branches to be initiated in the current year, to be opened in the current year. I think that, and that we'll try and see whether we can, sort of speed up in the first quarter, first half year itself. I think we'll be looking at how most of this can be opened in the first half year. So some bit of an uptick will happen on the capex side in terms of where we see expenditures happening. But I am confident that we can still control the cost to income ratio to well under 50. So that's where we will be. And the expenditure we are and our own initiatives internally discussed and initiated would see these additional expenditures coming from additional profits. So 10 to 12% of profit is something that we have given ourselves, and we will.
Okay, 10 to 12% PAT growth. Anyway, point taken, sir. Thank you so much, sir, for joining us this afternoon, giving us all of those insights. Wishing you all the very best for a very successful FY26. But out of time on this edition of KYC. Hope this was helpful, and stay tuned to NDTV Profit. More action on the other side.